Blockchain promises neutrality and fairness. Yet traders are unknowingly walking into an invisible battlefield where bots see and exploit their trades before confirmation. In theory, swapping tokens on-chain should be instant, transparent, and fair. After all, the blockchain is supposed to be a neutral ledger where everyone plays by the same rules. In practice, however, most traders are walking into an invisible battlefield, one where bots see your move before you do, and by the time your transaction confirms, you've already been squeezed for profit. Some traders lose hundreds of dollars on a single swap without ever knowing why. This is because trading on the blockchain is not like trading on a traditional exchange. That's why today, we're going to pull back the curtain on MEV Maximal Extractable Value and show you exactly how the invisible players are making money off your every click. By the end of this, you'll understand the mechanics, the predators, and most importantly, how to stop being prey. So, the reason MEV extraction can be so profitable is because of one factor: information asymmetry. The mempool, the waiting room where your transaction sits before it's confirmed, is not private. It's a public arena where advanced bots scan every pending trade, looking for opportunities to exploit. To put things into perspective, when you click swap, you think your transaction goes straight to the blockchain. In reality, it sits exposed in the mempool for seconds, sometimes just milliseconds, and, in that window, searchers analyze it, copy it, and reorder it to their advantage. This creates a predatory environment, especially if you're trading large amounts. When your transaction enters the mempool, searchers feel opportunity. When your swap finally confirms, you feel confusion, wondering why your $1,000 trade just cost you $1,100. Let's walk through what actually happens in those critical seconds before your trade confirms. You open your favorite DEX, connect your wallet, and decide to swap 1 Ethereum for a promising altcoin. You check the estimated output, adjust your slippage tolerance to 1%, and hit confirm. The interface shows a loading spinner. You wait 5 seconds, 10 seconds. Then finally, the transaction confirms. But when you check your balance, something feels off. You expected 1,000 tokens based on the quote. Instead, you received 950. You tell yourself it's just slippage, just the cost of doing business on-chain. But here's what really happened. The moment you clicked confirm, your transaction didn't go straight to the blockchain. It entered the mempool, a transparent waiting area where every pending transaction sits in full view. Bots monitoring this space immediately spotted your trade. They saw the token pair, the amount, and most importantly, your slippage tolerance. Within milliseconds, a searcher deployed to transactions, one to buy the altcoin right before your swap executes, driving the price up, and another to sell it immediately after, driving it back down. Your transaction got sandwiched between these two moves. The bot bought low, you bought high, the bot sold at your expense, and you walked away with fewer tokens than you deserved. This isn't a glitch. This isn't bad luck. This is MEV extraction in its most common form, and it happens thousands of times per day across every major blockchain. The worst part? You'll never see it coming, because by the time you realize what happened, the profit has already been extracted and the searcher has moved on to the next victim. Now let's break down exactly how a sandwich attack works, step by step, so you can see the mechanics behind the theft. Imagine you're swapping 10 Ethereum for a token called XYZ on Uniswap. The current price is 100 XYZ per Ethereum, so you expect to receive roughly 1,000 XYZ tokens. You set your slippage to 2% to account for normal price movement and submit the transaction. The moment it hits the mempool, a searcher bot picks it up. The bot calculates that your large buy will push the price of XYZ up significantly due to the liquidity pool mechanics. Here's where the attack begins. The searcher immediately crafts a transaction to buy XYZ tokens right before yours executes. But there's a problem. Transaction order isn't determined by who clicks first. It's determined by who pays the highest gas fee. So the bot attaches a massive gas price to its buy order, ensuring it gets included in the block before your transaction. When the bot's buy order executes, it drives the price of XYZ from 100 to 105 per Ethereum. Now your transaction executes at this inflated price. Instead of getting 1,000 XYZ, you get around 952 XYZ, but the attack isn't over yet. Immediately after your transaction confirms, the bot submits a sell order, dumping the XYZ it just bought back into the pool at the elevated price. The price crashes back down to near where it started, and the bot walks away with pure profit extracted directly from your trade. You paid more, received less, and the bot pocketed the difference. This entire sequence happens in a single block, often in under 12 seconds. No human could execute this. Only an automated system monitoring the mempool in real time can pull off this level of precision extraction. So, who are these invisible players extracting value from every transaction you make? They're called searches, and they operate in the shadows of the blockchain like modern-day composite men, manipulating the order flow to accumulate wealth while retail traders remain oblivious. These aren't amateur coders running scripts from their basements. These are sophisticated operations, often backed by venture capital, running high-performance infrastructure that monitors every mempool across multiple chains simultaneously. They deploy complex algorithms that can identify profitable opportunities in microseconds and execute multi-step strategies faster than you can blink. The most successful searches don't just run sandwich attacks. They engage in arbitrage, liquidations, and even more advanced strategies like backrunning and just-in-time liquidity provision. Some operate entire fleets of bots, each specialized for different types of MEV extraction. They pay validators directly for priority block space, essentially buying the right to reorder transactions in their favor. In many cases, they're working hand-in-hand with block builders, the entities responsible for assembling transactions into blocks. This creates a hidden economy where profits flow to those with the best technology, the deepest pockets, and the closest relationships with validators. What makes searches particularly dangerous is their invisibility. When you lose money to slippage, you assume it's just market volatility. When your transaction fails inexplicably, you blame network congestion. But in reality, a searcher may have front-run your trade, extracted the profit, and moved on before you even realized what happened. They don't need you to know they exist. In fact, they profit more when you remain ignorant, continuing to trade with wide slippage tolerances and public RPCs that broadcast your every move. To them, you're not a fellow trader. You're a revenue stream, a predictable source of extractable value. In an ocean of pending transactions, the MEV problem became so pervasive that it threatened the entire premise of decentralized finance. If every transaction could be exploited, if bots could always extract value from regular users, then the blockchain wasn't a fair playing field at all. It was a rigged casino where the house always wins. That's when a group of researchers and developers decided to fight back. They created Flashbots, a research and development organization dedicated to mitigating the negative externalities of MEV. Their solution was elegant. If you can't eliminate MEV, at least make it less predatory. Flashbots introduced a private transaction pool where users could submit trades without exposing them to the public mempool. Instead of broadcasting your swap for every searcher to see, you send it directly to trusted block builders who promise not to sandwich you. Searches can still extract value, but only through non-harmful methods like arbitrage and liquidations, not by front-running retail traders. This created a two-tiered system. Those who knew about MEV protection could route their transactions through private channels, while everyone else remained vulnerable in the public mempool. But Flashbots wasn't a perfect solution. It introduced new trust assumptions, centralized certain aspects of block building, and didn't completely eliminate the problem. Other projects emerged to fill the gaps. MEV Blocker, CowSwap, and private RPC providers all offered different approaches to shielding users from extraction. Some focused on order flow auctions, where the user captures the MEV instead of the searcher. Others used batch auctions to eliminate timing advantages entirely. The race to make the blockchain fair again had begun, but it also revealed an uncomfortable truth. The blockchain, in its raw form, was never designed to protect users from sophisticated adversaries. Protection required additional layers, trusted intermediaries, and compromises that contradicted the original vision of trustless decentralization. So now that you understand the battlefield, how do you actually protect yourself from MEV predators? The good news is that once you know the game, you can change how you play it. The first and most effective defense is using a private RPC endpoint instead of the default public one. Services like Flashbots Protect, MEV Blocker, and others allow you to route your transactions through private channels that don't expose them to the public mempool. This single change eliminates the majority of sandwich attack risk because searches simply can't see your transaction before it's confirmed. The second strategy is tightening your slippage tolerance. Most wallets default to 2% or even 5% slippage, which gives searchers a massive window to exploit. By reducing it to 0.5% or lower, you limit how much profit can be extracted from your trade. Yes, your transaction might fail occasionally due to genuine price movement, but that's far better than guaranteeing a loss to a bot. For larger trades, consider breaking them into smaller chunks executed over time. This reduces your price impact and makes you a less attractive target for extraction. Third, use decentralized exchanges that have built-in MEV protection. Platforms like CowSwap use batch auctions instead of continuous order matching, which eliminates the timing advantage that searchers rely on. Others offer limit orders, allowing you to specify the exact price you're willing to pay without exposing yourself to front-running. Finally, stay informed. The MEV landscape evolves constantly, with new attack vectors and new defenses emerging regularly. What works today might not work tomorrow. The dark forest of the blockchain will always exist, but you don't have to wander through it blindfolded. With the right tools and knowledge, you can navigate it safely, keeping your profits where they belong, in your wallet, not in a searcher's bot.